Hello, welcome back. Hope you're having a nice weekend. It's been a few busy days for me because I'm working on the stock analysis tool that I'm gonna be showcasing soon and using it for my analysis. It's tailored to what I'm doing here and I think you're going to like it a lot. So you may want to subscribe because you will be the first to know about the news for the tool and the first to actually see how it works. So it's good to have you around, guys. Thank you for being around, and for this video we're going to be taking a look at Gamestop, and we're going to actually also create a discounted cash flow model to see what's a price that we should be willing to pay for Gamestop based on what they're doing in their financials. And I just want to ask you if you are like this kind of content and you want to help the channel grow a little bit, please just like it because that really helps bring the content to more people. So let's move on. GameStop is a company that has been massively beaten down lately after it had its insane run due to this the very well-known short squeeze that happened about a year ago or so. And you will see that the outstanding shares of the company were actually lower for a while, and at some point they started creeping up again just because the company is using the stock prices to make some capital, just because it's elevated a lot right now. And so it does make some sense. And let's take a look at the company's income statement first and see whether they're doing well. You will see here that the year-over-year growth of the company is slacking a little bit in the previous years, and it's only the last 12 months that's been doing a little bit better. But the interesting thing here is that the net income is actually negative. Now, it's less negative than what it used to be, but it's still negative, so the company is actually losing money from its operations here. The balance sheet features two very important things here. The total liabilities of the company are sitting at $2 billion. They are down from what they used to be, which is obviously a good sign. But the total equity of the company is actually $1.7 billion from $2.2 billion. So the total equity is also going down. Now, what about the cash flow? The cash flow here from operations is negative in the last 12 months, and it's almost like a chessboard here. It's going like green to red and green to red. But the cash from investing, they're basically just investing in their capital expenditures, so not much to see here. And financing, as we saw just earlier, the company is issuing common shares in common stock in the last 12 months, and they paid back some debt, as we also saw in the balance sheet. And the free cash flow here, you will see that some years were positive, others were very negative here, and the last 12 months negative as well. So again, it's almost like a chessboard going from positive to negative here. The multiples of the company are rather low though, and they used to be extremely low in 2018 and 2019, but they are still pretty low. Anything below 3 is generally speaking good. The bad thing is that the company is not making any return on equity, so they cannot really use their equity to make money for stockholders. And so that's not a good thing here. But at least the solvency here, the total debt to equity is sitting at 38%. It's not bad, although you have to be cautious about a company not being able to make that much free cash flow. And the next thing that we're going to be examining here is the discounted cash flow model that I'm going to be using to project how much I want to pay for the company if I'm willing to buy it. And I'm going to be using the free cash flow items here, excluding this last one, which is the last 12 months, and it's very negative. So I'm willing to kind of exclude this one and just not pay attention to that, although probably I should, but I'm going to be a little bit lenient and I'm going to be using these values. And so for the first year, I'm just using a placeholder value here, which is basically the same. And the next 4 years is what we saw. Now, obviously, we cannot really use the average free cash flow growth, which is all over the place here. So I went for 10% a year annually, which may be a little bit optimistic in some situations, although we don't really know what the company is going to be doing. It's very tough to project this one. Again, it's all over the place. And the free cash flow growth to use, you can play with it a little bit. I'm just, as I mentioned, setting it to 10% for now. But I do want a higher discount rate just because this is a riskier investment here. And so I went for 15% is what I want to be making annually in order to invest in GameStop and make some sense. And the perpetual growth rate, I just use 0% because I want to be more conservative for this one because it's, again, a riskier investment. And the outstanding shares per in million I have pre-populated, it's 75.95. And you will see here that the price per share to pay today for the company is sitting at $10.21 if we account for all the free cash flow that the company has been making in the previous 5 years, and we project it into the future and discount the cash flows back to the present. This is what we are getting. And so currently the stock price is sitting at $118, which is way more than what we would want to get it at, which is again like about $10. And even if we go at a lower discount rate, like a 13% and let's say 20% free cash flow growth, which is insane, we are still sitting at $23, which is way off from again what the company is trading. So this is trading on hype, that's for sure. And you will see here that the company has a $9 billion market cap and it's making $63 million free cash flow a year. That's absolutely insane. I mean, that's very little cash flow for a company that's trading at $9 billion for a market cap. So yeah, you can see that this is a very overvalued in terms of long-term play, but it's a potentially interesting, very interesting probably, trading play. So you can actually use it for trading, because when you're trading charts and not companies really. And so this one, having a very limited outstanding shares count, a float as we call it for trading, is a company that can move a lot during the day. And so trading it on the upside and the downside can actually yield some nice money to you. But as a long-term investment, I'm a little bit cautious about it, and I probably wouldn't get my hands on it anytime soon. Let me know what you think about GameStop. Do you own it? Are you thinking of buying it? Are you trading it? What do you think? And if you did enjoy this video, you may want to take a look at this one that I made earlier. And it talks about Alibaba's recent headwinds and kind of discusses what the company is doing in terms of revenue and how they can potentially grow in the future, and basically discusses earnings. So I think it's a very interesting one, because I think Alibaba is a fair value right now, actually an undervalued company. And so you may want to take a look at it just to get some ideas. Thank you for watching this one, and I hope I see you soon. Bye bye.